All right, let's get right into it. We all have it. We use it every single day. But what actually is it? For just a second, I want you to forget this is money. Just look at it. It's this beautiful piece of paper covered in these incredibly intricate colored engravings. It's almost a little work of art, and it holds a pretty deep mystery.
Now take a closer look at what it actually says. Every banknote from the Bank of England has this phrase right on it: "I promise to pay the bearer on demand." A promise. You know, that sounds simple, but that one word is the key to this whole thing. A promise from who, and a promise to pay what exactly?
And that really is the million-dollar question, isn't it? If you were to walk into the central bank today and hand them a 10-pound note, they're not going to give you gold or silver anymore. They'll just give you another 10-pound note. So what on earth is this promise written on this fancy engraved paper actually worth? That's the mystery we're going to unravel.
To start, we gotta look at the paper itself, because all of that incredible artistry, it isn't just there to look good. No, it's the very first step in building something way more important, something you can't even see: trust. I mean, just look at this thing, a 1,000-pound note from 1854. The level of detail, the complex patterns, the sheer craftsmanship, it's absolutely stunning. And for centuries, this has been the signature of currency. But why? Why go to all this trouble?
Well, there were a couple of big reasons. As you can see from these early sketches and test prints, yeah, the beauty was a point of national pride. But it had a much more practical job: security. Making something this complex is incredibly difficult to fake. The art is basically a defense mechanism.
So here's the crucial point. The expensive paper, the fancy engraving, all the hidden watermarks, none of that is what actually gives money its value. It's all there to make you and me and everyone else believe that the note is authentic, that it's the real deal. It's all designed to build public confidence, to build trust. And that confidence, that trust, well, it's everything. Because when you get right down to it, money isn't really an object at all. It's more like a social technology. It was invented to solve one of humanity's oldest problems. How do you trade with people you don't personally know or trust?
The Bank of England actually has a really simple definition for it. They say money is just a special kind of IOU. You know, IOU. It's a record of a debt. But what makes it so special, unlike an IOU from a friend, is that this one is trusted by absolutely everyone.
And this quote just nails it. Money isn't a commodity like gold. It's a social institution. It's basically just an agreement that we all buy into. We accept it as payment because we know for a fact that everyone else will accept it as payment from us. It's a giant network of trust.
This breaks it down perfectly. Think about it. An IOU from your friend only works because you trust that one person. You can't take that piece of paper and go buy groceries with it, right? The cashier would laugh at you. Money solves that problem. It's the one IOU, the universal IOU that's accepted by everybody. And that's what makes our entire complex global economy possible.
Okay, so if money is really just this system of trust, what does it actually do? Well, economists have figured out that for anything to be considered useful money, it has to do three main jobs.
First, it's a medium of exchange. Pretty simple. It's what you use to buy stuff so we don't have to barter chickens for haircuts. Second, it's a unit of account. It's how we put a price on things, giving us a common language for value. And third, and this is a big one, it has to be a store of value. It should be worth roughly the same tomorrow as it is today.
This third job, being a store of value, is absolutely critical. Gold is a great example of a good store of value because, it doesn't rot. But perishable food? A terrible one. If your entire life savings was a giant basket of bananas, you'd better spend it really, really fast before it turns into a worthless pile of mush.
And when modern money fails at this job, the results are just catastrophic. Look at this number, 300 billion. In post-World War I Germany, an item that cost 1 mark in 1918 cost over 300 times billion marks by 1923. That's hyperinflation. It's what happens when trust completely collapses and that promise on the paper becomes meaningless.
Okay, and this brings us to what is easily the most surprising, most mind-bending part of this whole story. We tend to think of money as being printed by the government, right? But that is just a tiny, tiny fraction of the whole picture. So where does the rest of it, the vast majority of it, actually come from?
I mean, really think about it for a second. When you look at your bank account, what do you see? A number on a screen. That's your money. But it wasn't printed on some giant press. So how did it get there?
And here it is, the wild, surprising truth. The overwhelming majority of money in our modern economy is created, basically out of thin air, by commercial banks, every single time they make a loan. And look, this isn't some fringe conspiracy theory. This is exactly how the Bank of England describes how our system works.
Let's just break that down a bit. So there are two main types of money. You've got base money, which is the physical cash, the notes and coins, and the reserves that banks hold at the central bank. That's the foundation. But then there's broad money. That's all the digital deposits in our bank accounts. It's the money we use for pretty much everything, and it makes up the vast majority of all money in existence.
So how on earth does this happen? It's actually simpler and weirder than you might think. When a bank gives you a loan, it's not lending you someone else's savings. What it does is create a new loan on its books. That's an asset for the bank. And at the exact same moment, it creates a brand new deposit in your account for the exact same amount, and that's a liability for the bank. A new loan and a new deposit, created at the same time. Poof, new money. And just when you think your head can't spin anymore, we're going to look at this from a completely different angle. A recent paper from a wild field called ecophysics offers a radical new analogy, borrowing a concept straight from quantum mechanics to explain how money is created. Yeah, you heard me right.
So this paper proposes that every time a loan creates money, it also creates a corresponding debt as a perfectly symmetric pair. They compare it to physics, where energy in a vacuum can spontaneously split into a particle and its opposite, an antiparticle, which you can think of as a hole.
In this crazy analogy, money is the particle. It's mobile. It flows through the economy. It gets things done. And debt? Debt is the hole. It's the stationary counterpart. Locked into a contract, it's the empty space the money particle left behind. They are two sides of the exact same coin, born together in one single event.
And if you look at the economy through this lens, you see things in a whole new light. Paying back the principal on your loan, that's like the particle and the whole finding each other again. They recombine, they annihilate each other, and that money is destroyed. Interest? That's a force that breaks the perfect symmetry. And even something complex like quantitative easing can be seen as creating entangled pairs of different financial assets.
Which brings us to our final, big, thought-provoking question. If this wild analogy holds any truth, if money and debt really are an entangled pair created together and destroyed together, what are the consequences when our economic policies try to manage one side of that equation without even thinking about the other? What happens when we try to pull the particle and the whole apart?